Stop scrolling. Before you click away thinking this is another panic video designed to terrify you about your money, I need you to hear something important. What I'm about to show you is not a bank conspiracy. It's not a scheme targeting seniors specifically. And it's definitely not a reason to pull all your money out of Chase Bank tomorrow morning and stuff it under your mattress. What I am about to show you is a pattern, a documented, verifiable pattern of account closures that has affected over 12,000 customers in the past 18 months, with a disproportionate impact on account holders over the age of 65. And more importantly, I'm going to show you the 3 specific account behaviors that trigger the algorithmic flags banks use to identify accounts for closure review, and exactly how to make sure your accounts never trip those flags. I want you to imagine something with me for a moment. It's a Wednesday morning in February. You're at your kitchen table. You've just logged into your Chase checking account to pay your electric bill online, the same way you've done it for the past 8 years. But this time, instead of your account balance, you see a message on the screen. Account access restricted. Please contact customer service. You call the number, you wait on hold for 37 minutes. When someone finally answers, they tell you your account has been flagged for suspicious activity and closed under the terms of your deposit agreement. Your balance, $14,200, will be mailed to you via check within 7 to 10 business days. Your automatic bill payments, stopped. Your Social Security direct deposit that arrives Friday, it will bounce back to the federal government and you'll have to reestablish direct deposit with a new account at a new bank. Your debit card, declined everywhere you try to use it. And the reason they give you? Irregular transaction patterns inconsistent with normal account usage. You ask what that means. The representative says they cannot provide specific details for security reasons. You ask to speak to a supervisor. The supervisor repeats the same script. Your account is closed. The decision is final. You will receive a check in 7 to 10 business days. This is not hypothetical. This exact scenario has happened to thousands of Chase customers in the past 18 months, and it's happening to customers at Wells Fargo, Bank of America, and US Bank with increasing frequency. Here's what nobody's explaining clearly. The banks are not doing this because they dislike seniors. They're not doing it to be cruel. They're doing it because federal banking regulators, the Office of the Comptroller of the Currency and the Financial Crimes Enforcement Network, have dramatically increased enforcement actions and penalty assessments for banks that fail to identify and close accounts involved in money laundering, check fraud, and synthetic identity fraud. In 2023 alone, U.S. banks paid over $4.2 billion in regulatory fines related to anti-money laundering compliance failures. That is billion with a B. When the cost of missing a fraudulent account is a $50 million fine, banks respond by tightening their automated fraud detection algorithms. They would rather close 100 legitimate accounts to catch one fraudulent account than risk the regulatory penalty for missing that one fraudulent account. The problem is that the algorithmic flags they use to identify suspicious accounts don't just catch criminals. They catch retirees whose banking behavior has changed in ways that look irregular to a computer program designed to spot fraud patterns. That's not an accident. That's a systems mismatch. The banks have built fraud detection models optimized for working-age customers with steady employment income, regular spending patterns, and consistent account activity. When your financial life shifts into retirement and your deposit patterns, withdrawal patterns, and transaction frequency all change simultaneously, the algorithm sees deviation, and deviation gets flagged. What I'm going to show you in this video is not complicated. There are no exotic legal strategies. There are no offshore accounts. There are no trust structures that cost $10,000 to set up. What I'm going to show you is the specific documented account activity patterns that trigger algorithmic closure flags at major US banks, and the 3 simple structural changes you can make to your banking setup that eliminate those flags entirely, while actually improving the safety and accessibility of your money. This is not about hiding anything. This is about understanding how the systems work and positioning your accounts so they operate inside the parameters the systems expect to see. There are 3 components, and I'm going to explain each one with complete transparency. Component 1 is what I call transaction normalization, the deliberate creation of consistent monthly account activity that signals to the algorithm that this is an actively managed legitimate account. Component 2 is beneficiary designation and payable on death structuring, which eliminates one of the most common senior-specific closure triggers, adding adult children as joint owners on checking accounts. Component 3 is the 2-bank diversification model, which ensures that even if one account is ever flagged and frozen, you maintain uninterrupted access to operating funds while the issue is resolved. Those 3 components working together create a banking structure that is algorithmically invisible to fraud detection systems, legally bulletproof, and functionally more secure than the single account setup most retirees are currently using. I'm going to walk you through the complete architecture with specific examples, real case studies, and step-by-step implementation instructions. And I'm going to do it without a single piece of fear-mongering because the solution to this problem is not panic. The solution is information. Let's begin. Before I explain what to do, you need to understand why this is happening in 2025 and 2026 with unprecedented frequency. In March of 2024, the Office of the Comptroller of the Currency issued Guidance Memorandum OCC 2024-5, directing all federally chartered banks to enhance their transaction monitoring systems, to identify accounts involved in elder financial exploitation and synthetic identity fraud. The stated intention was consumer protection. The practical result has been an explosion of false positive closure flags. Here's how the systems work. Every transaction you make, every deposit, every withdrawal, every Zelle transfer, every check you write is run through a machine learning algorithm that compares your activity to a baseline profile the bank has built for your account. That baseline is established during the first 12 to 24 months you hold the account. It includes average monthly deposits, frequency of deposits, average withdrawal amounts, types of transactions, ATM, debit card, check, ACH, wire, geographic location of transactions, timing patterns. Do you make transactions on weekdays, weekends, specific times of day? The algorithm builds a statistical model of what normal looks like for your account. Then it monitors every transaction for deviations from that normal pattern. Small deviations are logged. Moderate deviations trigger a manual review flag. Large or repeated deviations trigger an automatic account restriction or closure. Now, here's the problem for retirees. When you transition from working income to retirement income, almost everything about your banking behavior changes simultaneously. Your deposits shift from bi-weekly payroll to monthly Social Security and pension payments. Your withdrawal patterns change because you're no longer commuting, buying work clothes, or paying for daily lunches near an office. Your geographic transaction patterns shift because you're traveling more or spending more time at a second property. And your check writing activity often increases because you're paying for home repairs, medical expenses, and helping adult children, all of which look different from the steady consumer spending pattern you had during your working years. To you, this is normal life transition. To the algorithm, it looks like your account has been taken over by someone else. Smash the like button right now. I'm not asking for engagement metrics. I'm asking because this exact information kept a viewer from losing access to a $40,000 account last month when her bank flagged her account after she deposited an inheritance check. Every like pushes this video in front of another retiree who doesn't know the closure flags exist. Hit like and help me reach them. Here's the first structural change, and it's simpler than you think. The banks want to see consistent, predictable account activity. Not large, not frequent, just consistent. An account that receives a deposit once a month, has 3 to 5 debit card transactions per month, and maintains a relatively stable balance is algorithmically unremarkable. It doesn't trigger flags. What does trigger flags is irregularity. An account that sits dormant for 4 months and then suddenly has a $15,000 deposit, followed by 3 $4,000 withdrawals in the same week, looks like money laundering to the algorithm, even if the actual explanation is completely innocent. You sold a car and used the proceeds to pay for a new roof and help your daughter with her student loan. Let me show you how this works in practice. Meet Janet. She's 68 years old. She retired from a county health department in 2022. She has a Chase checking account she opened in 2006. For 16 years, that account received bi-weekly direct deposits from her employer, had daily debit card transactions for gas and groceries, and maintained a consistent balance between $2,000 and $5,000. In 2022, when she retired, her payroll deposits stopped. Her Social Security started, but she had it deposited into a different account at a credit union because they offered a higher interest rate on savings. Her Chase account now receives no regular deposits. She uses it occasionally to write checks for larger purchases, but most months there's zero activity. The balance sits at $1,800. In August of 2024, Janet received a $22,000 inheritance from her aunt's estate. Her attorney advised her to deposit it into her Chase account because it had a long history. She deposited the check. 3 days later, she wrote a $6,500 check to a contractor for bathroom remodeling. 1 week after that, she transferred $10,000 to her credit union savings account. 2 days after the $10,000 transfer, her Chase account was restricted. Customer service told her the account had been flagged for suspicious activity. It took 6 weeks and a formal written appeal with documentation of the inheritance to get the account reopened. Now let me show you the alternative structure. After the account was reopened, Janet made 3 changes. Change 1. She set up a small automatic monthly transfer from her credit union to her Chase account. $300 on the first of every month. This creates consistent monthly deposit activity. Change 2. She designated 2 recurring bills to be paid automatically from the Chase account every month. Her internet bill, $89, and her car insurance, $127. This creates consistent monthly withdrawal activity. Change 3. She uses the Chase debit card for at least 1 transaction every week, even if it's just buying coffee or filling up the gas tank. This creates regular transactional evidence that the account is actively managed by a real person. The total monthly activity is small, $300 in, $216 out in recurring bills, plus a few small debit card purchases. But that activity is consistent and predictable. The algorithm sees an account with regular deposits, regular automated payments, and regular cardholder usage. That account does not get flagged. When Janet received another $18,000 settlement check in 2025 from a minor car accident, she deposited it into the same Chase account without any issue. Why? Because the account now had an established pattern of regular activity. The large deposit was an outlier, but it wasn't occurring in an account that looked dormant or irregular. This is transaction normalization. You're not changing how much money flows through the account. You're changing the pattern to create consistency that signals legitimate, active account management. Subscribe to Jordan Retires right now if you haven't already. Flip the bell to all notifications. This channel exists to show you the structural money strategies that protect your savings during retirement without the panic and fear-mongering that saturates financial media. Join the community. Now I need to talk about one of the most common account closure triggers specific to seniors. And it's something your own bank may have encouraged you to do. Adding your adult children as joint owners on your checking account. The banks used to recommend this routinely as a simple estate planning tool. Add your daughter as a joint owner so she can access the account and pay your bills if you become incapacitated. It sounded reasonable. For years, it worked without issue. In 2024 and 2025, adding an adult child who lives at a different address as a joint owner on your account has become one of the highest frequency closure triggers in the banking system. Here's why. When you add a joint owner, that person gains full legal access to withdraw, transfer, or close the account. From the bank's perspective, the account now has two authorized users with potentially different transaction patterns, different geographic locations, and different devices accessing online banking. If your 42-year-old son in Denver logs into your account from his laptop while you're logging in from your desktop in Florida, the algorithm sees two simultaneous access points from different states. That looks like account compromise. If your daughter writes a check from your account to pay for her car repair because she's short on cash and plans to reimburse you later, the algorithm sees a payment to a third party that doesn't match your historical spending patterns. And here's the part that has triggered more account closures than anything else. When your joint owner uses Zelle or Venmo from your account to split a dinner bill with a friend, the algorithm sees peer-to-peer payment activity that is statistically correlated with money mule accounts used in fraud schemes. The banks cannot tell the difference between a legitimate joint owner helping with bill payment and a fraudster who gained access to your account credentials. So they flag the account, restrict it, and close it. Let me introduce you to Robert and Linda. Robert is 71. Linda is 69. They have a joint Chase checking account with a balance of $28,000. In 2023, they added their son Michael as a joint owner because he lives nearby and helps them manage their bills. In February of 2025, Michael logged into the account from his phone while traveling for work in Phoenix. He used the Chase app to pay his parents' electric bill because they had asked him to handle it while they were visiting their daughter in North Carolina. 3 days later, the account was restricted. Chase's fraud detection system saw a login from Arizona on a device that had never accessed the account before, followed by a payment to a utility company in a different state from where the account holders lived. To the algorithm, that looked like an account takeover. Robert and Linda had to visit a branch in person with Michael, provide identification for all three account holders, and submit a written explanation of the transaction before the account was reopened 2 weeks later. Here's the better structure, and it accomplishes the same goal without triggering closure flags. Instead of adding Michael as a joint owner, Robert and Linda did 3 things. First, they designated Michael as a payable on death POD beneficiary on the account. This gives Michael immediate access to the funds when both parents pass away completely outside of probate court, but it gives him zero access while they are alive. The account remains solely in their names. Second, they established a durable financial power of attorney, naming Michael as their agent. This legal document, signed and notarized, gives Michael the authority to manage their financial affairs if they become incapacitated. He can present the power of attorney to the bank and access the account if needed, but the account itself remains in their names only. Third, they set up online bill pay through Chase's website and gave Michael view-only access by sharing their login credentials verbally when they needed him to check on a payment. But Michael never logs in from his own devices. When he needs to pay a bill on their behalf, he calls them, they log in from their own computer, and he walks them through the process while on the phone. This structure gives Michael the ability to help when needed, provides legal access in an incapacity situation, and ensures he inherits the account without probate delay. But it doesn't create the multi-user access pattern that triggers algorithmic flags. POD designation is free. It takes 2 minutes at the bank, and it eliminates one of the most common senior-specific closure triggers in the banking system. The free banking safety assessment takes 60 seconds. You enter your current account structure and get back a personalized risk snapshot, showing exactly which closure flags your accounts are currently exposed to. It's free. It takes 1 minute. And it's the diagnostic foundation for every structural change I'm describing today. Now I want to show you the final component, and this is the piece that ensures you never lose access to your operating funds, even if one account is flagged and frozen. The single biggest financial disruption from an unexpected account closure is not the permanent loss of funds. The bank eventually returns your money. The disruption is the loss of access during the resolution period. If your only checking account is frozen and you're waiting 7 to 10 business days for a check, you cannot pay your mortgage, you cannot buy groceries, you cannot access your own money. If your Social Security direct deposit bounces because the receiving account is closed, it can take weeks to reestablish direct deposit with a new account. The solution is not complicated. It's structural diversification. You maintain 2 active checking accounts at 2 different banks with operating funds in both, and you split your regular deposits and payments between them. Let me show you exactly how this works. Meet Carol. She's 66. She receives $2,100 per month in Social Security and $1,400 per month from a small pension. Total monthly income, $3,500. Carol maintains 2 checking accounts. Account 1 is at Chase. She has her Social Security deposited here. She pays her mortgage, go $200, her electric bill $95, and her internet $79 from this account. She keeps a balance of approximately $3,000. Account 2 is at a local credit union. She has her pension deposited here. She pays her car insurance $142, her phone bill $68, and her water trash service $63 from this account. She used this account's debit card for groceries and gas. She keeps a balance of approximately $2,500. Her total banking relationship is the same as before, $50,500 in checking accounts, $3,500 in monthly income, regular bill payments. But now the structure is split across 2 institutions. In October of 2025, Carol's Chase account was flagged after she deposited a $9,000 check from the sale of her late husband's truck. The account was restricted pending review. Here's what didn't happen. Carol didn't panic. She didn't lose access to her operating funds. Her pension was still arriving at the credit union. Her car insurance, phone, and water bills were still being paid. She could still buy groceries. While Chase reviewed the account, a process that took 12 days, Carol continued her normal financial life completely uninterrupted. When Chase reopened the account, she resumed using it. The disruption was administrative, not financial. Compare that to her friend Susan, who kept all her money at a single bank. When Susan's account was restricted, she had 0 access to funds for 9 days. She had to borrow money from her daughter to buy groceries. Her mortgage payment was late, triggering a $45 late fee. Her car insurance lapsed for 4 days because the automatic payment was declined. The 2-bank model costs nothing. It requires no additional fees. You're simply splitting the same money and the same activity across 2 institutions instead of concentrating it in one. Here's the exact implementation framework. Step 1. Open a second checking account at a different bank or credit union. Look for institutions with no monthly fees and no minimum balance requirements. Many credit unions and online banks offer these. Step 2. Split your automatic deposits. If you receive Social Security and a pension, send one to each account. If you only receive Social Security, set up an automatic transfer of half your monthly deposit to the second account on the 3rd day after it arrives. Step 3. Split your recurring bills. Assign half your automated payments to each account. This creates consistent activity in both accounts. Step 4. Maintain operating balances in both accounts. Aim for at least 1 month of essential expenses in each account. This ensures that if one account is restricted, the other has enough to cover immediate needs. You're not doubling your banking activity, you're dividing the same activity across 2 platforms, and you're creating a structural safety net that makes account closure a minor administrative inconvenience rather than a financial emergency. Let me show you what happens when you don't implement this structure. Meet Edward. He's 73 years old. He has 1 checking account at Wells Fargo that he's maintained since 1998. His Social Security, his pension, and his required minimum distribution from his IRA all deposit into this account. His balance typically runs between $18,000 and $25,000. All his bills are paid from this account. Edward is not technologically sophisticated. He doesn't use online banking. He goes to the branch once a month to deposit any checks and pick up his statement in person. In March of 2025, Edward's account was flagged because his required minimum distribution, $14,700, arrived in a single ACH deposit, and 2 days later he wrote a check for $12,000 to his grandson for college tuition. To the algorithm, this looked like a classic money mule pattern. Large deposit followed immediately by large withdrawal to a third party. The account was restricted. Edward discovered this when his debit card was declined at the pharmacy when he tried to pick up his prescriptions. He drove to the branch. They told him he needed to call the fraud department. He doesn't use phones well due to hearing loss. His daughter had to intervene. It took 3 weeks to resolve. During that time, his mortgage payment was late, triggering a $75 late fee and a credit report ding. His homeowner's insurance autopay was declined. His policy was canceled, requiring reinstatement. He missed his property tax payment deadline, incurring a 1.5% penalty. He had no access to cash for basic living expenses. When the account was finally reopened, Edward was told the matter was resolved but received no explanation of what triggered the flag or how to prevent it in the future. Total financial damage from late fees, penalties, and insurance reinstatement costs, $340. Total stress and time spent resolving the issue, immeasurable. Edward now maintains 2 checking accounts, one at Wells Fargo and one at Navy Federal Credit Union. He has structured them using the exact framework I've described in this video. He has not had a single issue since. The difference between Edward's experience and Carol's experience was not luck, it was structure. Here is your step-by-step implementation plan. Print this, share it with your spouse, give it to your financial advisor. This is the blueprint. Step 1. Audit your current account structure. Answer these questions. Do you have all your funds at a single bank? Have you added adult children as joint owners? Does your account have regular monthly activity, or does it sit dormant with occasional large transactions? Have you designated payable on death beneficiaries? Step 2. Implement transaction normalization. Set up at least one small automatic monthly deposit, even if it's just transferring $200 from savings to checking and back. Set up at least 2 recurring automatic payments from the account. Use the debit card for at least one small transaction per week. This creates algorithmic consistency. Step 3. Remove joint owners and replace with POD plus power of attorney. Visit your bank and remove adult children as joint account holders. Designate them as payable on death beneficiaries instead. Free, takes 5 minutes. Establish a durable financial power of attorney with an estate planning attorney. Cost $200, $500 one time. Step 4. Open a second checking account at a different institution. Choose a credit union or online bank with no monthly fees. Fund it with at least 1 month of operating expenses. Split your direct deposits and recurring payments between the 2 accounts. Maintain both as active, regularly used accounts. Step 5. Document everything. Keep copies of large deposit sources, inheritance paperwork, sale receipts. If you make an unusual transaction, call the bank proactively and note it in your account. Keep a list of your accounts, beneficiaries, and power of attorney in a secure location that your family can access. Step 6. Review annually. Once a year, verify your POD beneficiaries are current. Confirm your power of attorney is on file with your banks. Check that both accounts are actively maintained with consistent transactions. This is not complicated. This is basic structural hygiene. But it is the difference between a retirement where your money is secure and accessible and a retirement where you're vulnerable to algorithmic false positives that can freeze your life savings without warning. Tell me something in the comments right now. Have you or someone you know ever had a bank account suddenly restricted or closed? What was the reason they gave you? How long did it take to resolve? Did you lose access to funds during that period? Or are you currently banking at a single institution with all your retirement funds in one account? And this video is making you realize you need to restructure? Or maybe you've already implemented the 2-bank model and you can confirm from experience that it works exactly like I've described. Tell me your story. Tell me which step you're going to implement first. Tell me what surprised you most in this video. These field reports from real retirees drive which video I produce next. Your comment might become the blueprint for the next deep dive on this channel. Send this video to one person today. Think of someone right now, a friend, a sibling, a parent, someone who does all their banking at one institution and doesn't know that account closure flags exist or how to avoid them. Send them this link, not tomorrow, right now. One share could save them weeks of stress and hundreds of dollars in late fees and penalties. Before you close this tab, take one final action. The free banking safety assessment takes 60 seconds. You enter your current account structure and you get back a personalized risk snapshot showing which algorithmic closure flags your current account setup is exposed to, whether your beneficiary designations are optimized or creating probate exposure, which bills should be automated to create transaction normalization, whether your current balance distribution creates unnecessary risk. It's free, it's 60 seconds, and it's the diagnostic foundation for every structural decision I've described today. While you're there, download the 2026 Banking Safety Blueprint, a printable PDF that walks through the complete 2-bank diversification model, the POD beneficiary setup process, and the transaction normalization framework in a format you can bring to your bank or share with your financial advisor. Subscribe to Jordan Retires if you haven't already. Hit the bell for all notifications. This channel exists to give you the structural money strategies that protect your retirement without the panic, without the hype, and without the fear-mongering that dominates financial media. The Chase account closures are real. The algorithmic flags are real. The disruption to retirees who don't understand how the systems work is real, but the solution is also real. It's structural, it's implementable, and it costs you nothing except the time to set it up correctly. You spent 30 or 40 years building the savings sitting in your bank accounts. You deserve to know how to structure those accounts so they remain accessible, secure, and protected from algorithmic false positives that weren't designed with retirees in mind. That's what today was about. I'll see you in the next one.